Here's a headline you'll see more often than you'd think. The Dow closes at a record high. And right next to it, another headline, stocks fell today. Same market. Same trading session. Both true. So which is it? Did the market go up or did it go down? It went both. And the reason is something almost nobody bothers to explain. The Dow and the S&P 500 are not measuring the same thing. They're not even measuring it the same way. Start with the Dow. The Dow Jones Industrial Average tracks 30 companies, and it's what's called price-weighted. A company's pull on the index comes from its share price, not from how big the company actually is. A stock trading at $400 a share moves the Dow more than a stock trading at $40 a share, even if that $40 company is worth 10 times as much as a business. It's a genuinely strange way to build an index. Imagine ranking a town's families by the height of their front door instead of by what they're actually worth. That's roughly what price weighting does. It lets the share price, an almost arbitrary number a company can cut overnight with a stock split, decide who matters most. Now the S&P 500. It tracks around 500 companies, and it's market cap weighted. A company's pull comes from its total market value, share price times every share outstanding. So the giants, the biggest technology names, carry enormous weight. When they move, the S&P moves with them. The Nasdaq Composite works the same way, just with thousands of names instead of hundreds. Once you see that, the contradiction dissolves. Picture a day where the largest technology companies sell off, and money rotates into industrial and financial names that happen to trade at high share prices. The cap-weighted indexes, the S&P and the Nasdaq, sink because those giant tech names are most of their weight. But the Dow? Those high-priced industrials are pulling it the other way. One index goes red. The other prints a record. Nothing's broken. They're just built differently. There's also breadth. The Dow holds 30 stocks. The S&P holds 500. A small group of names can carry the Dow to a record while most of the broader market is quietly falling, and the S&P, with far more companies inside it, will show you the wider weakness the Dow hides. So which one's right? Both. They just answer different questions. If you want to know what a few large, established names did, the Dow tells you. If you want to know where the money actually sits, where the weight of the market really is, the S&P is the better read. That's why most professionals watch it over the Dow. And the price weighting in the Dow isn't some deep insight. It's a leftover from 1896, when Charles Dow was adding up share prices by hand because cap weighting wasn't practical to calculate. We kept the index. We kept the quirk. So the next time the Dow sets a record and you hear that stocks fell on the very same day, you won't be confused. You'll know to ask the only question that matters: which market are they showing me? Because the market was never one number. It's a lens, and the whole game is knowing which one you're looking through. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.